evidence this morning, and particularly so because of the strike. We're reasonably pressed for time because there are Treasury questions to the Chancellor in the House today. Could I begin by asking you, Mr. Rao, we've had quite a number of submissions that businesses took out loans with embedded interest rate hedging products because they trusted their bank to give them the product that they needed. Do you think that's typical among SMEs, that they have trusted banks and ended up in products which have not been appropriate for them?
It's certainly typical, particularly of those individuals who've been involved in interest rate hedging products proper or embedded swaps, because all of them have been asset rich, and by and large that means that they're of a certain age, and that generation believed that the banks were a trustworthy partner and had confidence in their banks. In practice, that confidence has proven to be sadly misplaced.
Do you want to add anything to that, Mr. Beer?
I think what Jeremy said sums up exactly how I felt. I was in a situation in the latter part of 2008 where my loan structure was with HBOS. HBOS were a bank that was becoming non-cooperative, and we had commercial day-to-day facilities with HSBC, and HSBC were wanting to withdraw those facilities. And we met Clydesdale, who had a local relationship manager, and he spent a lot of time with me, looking over my business plan for about 4 months and understanding my business. So I genuinely felt that here was a bank that was actually working in Bath, that was looking at us and understood what we were doing, and I had a regular dialogue with him, so I felt a great deal of trust in that bank. I wouldn't say that I trust them at all anymore.
Is there anything you want to add to this initial question, Mr. Murphy?
I think pre-2008 banks actively marketed themselves as trusted advisor, trying to build that strength of relationship with clients to retain the client. So that was an active approach that they adopted to retain clients, and for these size of clients, SMEs, they couldn't necessarily afford access to third-party professionals, so they were open to that relationship and that approach.
Okay. Do you think that we can restore trust through better quality handling of this type of business by banks, or do you think this can only be cured by competition, or both? Perhaps I'll start with Mr. Rowe and then move again to the other two.
Well, the first thing that has to happen is that banks themselves have to change their conduct and have to change their attitude in the process where they lend to small and medium-sized businesses. And I don't believe that that has happened yet to any meaningful extent, and I don't think our members believe that it's happened yet to any meaningful extent. The issue is that the banks have to change the way in which they conduct themselves, and then it is up to various parties to ensure that their conduct is proper going forward.
Including the regulators.
Sorry?
Including the regulators.
Absolutely. It's up to the regulators, all of the regulators. They've each got a role to play, and truly looking back over this whole scenario, I don't think any of the regulators have covered themselves in glory. Hopefully there is a change there, there's a sea change there, and they are starting to recognise that they do need to monitor the banks much more effectively, and perhaps be a little bit more assertive in the way in which they regulate. But there's also a role for government, and there's a role for the professions within the country. The banks are Goliaths. They're on our high streets. They are out of all proportion, all scale to the parties with whom they do most of their business, and there has to be effective control over them.
Mr. Beer, then I'll ask Mr. Murphy to comment, who has particular experience of one of the Goliaths.
I think if you're looking at me as just an example representative, I'm a small business person. I own a small hotel, like thousands of other people, and I started out in business 11 years ago where I had a relationship where I actually looked forward to having a conversation with my bank, and I trusted the advice that they gave me because I felt that they were a partner that was interested in the long-term success of my business. I think that there has been clear deceit on their part, particularly with Clydesdale, in terms of what was said to me and then what was delivered. And I think the only way you're going to change that is to put greater control around the bank and how they actually sell their products to SMEs. You know, the information that we were given was sorely lacking. And I can sum that up simply by saying, if in the process of completing our loan, if they had turned around and said to me, do you understand that on day one you will have a breakage cost in excess of £1 million relative to this £3.9 million loan, do you honestly think that I would have said that's perfectly acceptable? And for the bank to say, well, we told you there were breakage costs, so you should have understood, that's, to me, where trust breaks down. The bank understood what it was selling, and it relied upon the fact that I didn't.
Is what we've just heard endemic or an exception, Mr. Murphy?
In terms of bank behaviours,
Cases like that.
Unfortunately, there's a lot of those cases. It was a particular point in time when that behaviour was happening, but yes, it's, you know, those events do happen.
Yeah, but my question is not do they occasionally happen, but have we got an endemic problem here?
I think it's changing. I think bank behaviours have changed. There was a lot of pressure on banks to cross-sell products, which created a certain type of behaviour. It became more of a sales culture than a credit culture, than a lending relationship culture. That was one of the key changes in banking through the 2000s, and that's what's behind a lot of the issues that we've got now.
So you're suggesting it is a recent phenomenon that developed in the last decade, and which has been flushed out as a consequence of the crash, and which we're now putting right?
Putting right, not yet. I think William and Glynn's coming out of RBS will be a step in the right direction because that creates more competition. I think we need to keep the co-op alive and healthy because, again, that creates more competition.
That could be quite an undertaking, but do carry on with your list of proposals.
I think, yeah, but the cost of not doing it could be a lot more expensive because we'll be back here in 20 years' time if we're not careful and actually put some fundamental changes into the market. I think FOS is just not fit for purpose for SMEs. We contacted FOS yesterday and asked them how long will it take to get a reply, and they said we're just picking up files that were submitted to them in June, so they've got a 10-month backlog on SMEs, and they're only micro businesses anyway. An SME that's north of 2 million turnover euros, it's got nowhere to go really, apart from internal complaints. There's no third party it can appeal to.
Sorry, did you say that the first line response from the Financial Ombudsman Service will have a 9-month lag? Is that what I heard?
10 months.
10-month lag?
We phoned them yesterday, one of my colleagues, and the answer was he was picking up files from June 2013.
Okay.
So that service is just not fit for purpose for the SMEs.
Well,
and a lot of the problem is
several points there. There's the core remedy. It's not working, but the market itself is highly dysfunctional if this kind of behaviour is persisting, despite the fact that we understand it. Well, you want to add something, Mr. Reddy?
Well, I do. I disagree quite strongly with Tim. I do not believe that the banks have changed their behaviour. I do not believe the banks have changed their attitude.
They're still in the sales culture rather than the credit culture, as Mr. Murphy put it.
Yes, and I think a change of culture begins with a wholehearted acceptance of responsibility, and that hasn't happened.
Okay. John Thurso.
Can I come to you first, Lawrence? By the way, Chairman, I should perhaps say that Lawrence and I share a qualification. We're both master in holders. Nice to see you. What I'm really interested in trying to work out is whether the cases like yours are instances of bad luck and timing, or deliberate, or even perhaps accidental mis-selling by the banks. So can I ask you, when you went through the process with the trusted bank manager who you thought was going to be helping you and advising you, how was the facility referred to? Was there at any time in the dialogue reference to embedded swaps, hedges, things of that nature?
I think I'd start by saying I think there was deliberate intent to sell what was best suited to the bank. The gentleman that I worked with, Ian Harris, I think was very positive and took a lot of time to understand the business, wrote up his report, put it to credit, etc. It was the final process, how we moved into a fixed rate, that gives me the greatest cause for concern. I had always taken a relatively conservative approach to how we run our business. We do not have large financial resources. We had taken on a high level of debt. And so what I wanted to create was effectively a mortgage payment. I wanted to know at the end of every month what I was going to be obligated to pay, and then build my business model around it and ensure that I could meet that obligation. So we'd always said we'd taken fixed rates before we were interested to take a fixed rate. What happened was we were then told, well, when you move into a fixed rate, that's a specialist service and we'll need to introduce you to our Treasury department to do that. So we had a telephone...
But the terminology was always fixed rate?
Yes. And I know notionally in my head it's, it's you're paying a higher interest rate for accepting here's a permanent amount of money. It is not explained the methodology by which that is done and the complex nature of what you're entering into. They make it very simple and very straightforward. When I spoke to Graham Batstone, who was the gentleman at Treasury, he basically presented me with three options, saying there was a 10-year rate, a 15-year rate, and a 21-year rate. And the difference on the margin on those three rates was 10 basis points. It was nominal. And his advice, and it was advice, was you should take the 21-year rate because interest rates are at 0.5% at this point in time. This will protect your business from rate rises. It's the best thing to do.
So just to get this straight, you have how long a facility for?
So we took...
you still have the facility? We
still have the facility. We are still in business.
Right.
So we have 16 years left to run on the original term of that loan.
And if interest rates do go up, then for a large part of that loan, that will have proved to have been a good decision.
Yes, it would. The problem comes when your relationship breaks down with your bank and your bank then start putting pressure upon you. When I originally met with Ian Harris, it was, we know we are in this as your partner for long term, for good and for bad. We understand that. That relationship fundamentally changed when NAB decided to exit the UK market and put Clydesdale up for sale. The Bath office was closed, etc., etc. We now no longer have a positive relationship with the bank. The relationship actually got so bad as to be moved over to their specialist banking services because they felt that there was concern over our ability to meet cash flow requirements. And we've lived under that structure. We were transferred to them with 48 hours notice before
so
a VAT
the real
payment.
problem here, I mean, what you did could have been construed as a good business decision if you were having a constructive relationship with that bank for the next 16 years.
And
the core of the problem, if I've got it right, is that you have been sold something that linked you irrevocably to their fortunes, and the only way of doing something about it is for you to pay a 30% of the loan in a penalty charge. That's basically
it. And at no point were we given an understanding that that was the risk that we were taking on in that structure.
So the critical point is that whilst the arrangement was a perfectly sensible one and could look good, all the fine print that makes it something you wouldn't have touched with a barge pole was simply not explained to you. Can I come to you, Jeremy Rowe? Through both Bully Banks and the NAB support group, this will be a story you are very, very familiar with, is it not?
Yeah.
Is the tale that Lawrence is telling one that you see consistently across all the other complainants?
Every case is individual and is specific. But in broad terms, yes. I mean, we've done a survey of our membership, and of those with hidden swaps, sort of 68% of those loans were put in place to replace variable rate facilities. So the individuals had borrowings and a decision is taken to change to a fixed rate. In 77% of those cases, the banks were warning individuals that interest rates were going to move higher. In 89% of those cases, it was the bank's idea to fix rates. In 84% of the cases, the banks pressurised the businesses to fix rates. In 97% of the cases, the customers were unaware of the commission structure. In 96%, they were unaware of the breakage costs that they were running into. So there is a consistent pattern of the banks promoting, at best, pressurising at worst, businesses to enter into fixed rate commitments without properly explaining the financial implications of the break costs.
So this would fulfil the classic definition of mis-selling?
In my view, it does.
Absolutely. Does it surprise you, therefore, that the Treasury and the government seem decidedly uninterested in the idea, and the FCA don't want to have anything to do with it?
I find it extraordinary. We're in a situation where 2 years ago we started bully banks, raised an issue about the sale of a specific product, interest rate hedging products, and that was dismissed. We pressurised, we campaigned. We have now a situation in which over 10,000 businesses have had results from the bank's determination, and over 80% of those have found to have been substantially missold. We're in a rerun. We now have another product which is on the table. We learnt earlier this month that there are some 70,000 of those products that have been sold. So 70,000 people have got these products, and we are saying, a number of our members are saying that they have been missold. Why on earth wouldn't the regulator investigate that? Why on earth wouldn't the Treasury demand that the regulator investigate it? It is an issue of profound economic and social importance. You have a series of institutions who it is alleged have missold this product. We're standing here and saying 2 years ago we said the same thing about interest rate hedging products. Our claims were modest and have been wholly substantiated. We're repeating the same issue now. There is a problem in the way in which these products were sold. Many thousands of small businesses have these products. We don't know how many of them have been missold, but it is probable that a large number have been missold. Therefore, the regulator should investigate the sale of those products.
When I raised these issues informally, some 18 months ago or so, I was given what appeared to be wholly misplaced assurances that these problems are either exaggerated or non-existent. So what you've said is consistent with my own anecdotal experience. Before passing the questioning on to Stuart Hosey, Mr. Murphy, is there anything you'd like to add about how we tackle and address these problems? As you've had experience on the other side of the counter,
I think
you can now offer us suggestions on what to do about it.
On the TBLs, I think a standalone bank facility letter is difficult for a non-financially aware person to understand and all the nuances of that facility letter, and it's skewed towards the bank. It's in the bank's favour. There's clauses in those facility letters which are standard clauses which the bank can use to put the facility into default and then drag them through the recoveries teams. So you've got that issue with the facility letter on its own as a standalone document. For the likes of Yorkshire Bank to then embed in that a Treasury document, it almost makes the thing completely unintelligible. Now, if you actually looked at them as two isolated situations, so you've got your swap and a loan, and then you've got the TBL, there's two separate companies, two separate products, you'd actually say that the SME's got more chance of understanding the swap and the loan as a standalone product than he has of ever understanding that TBL with an embedded swap. The documentation is just, if you sit down and read one, and I've read a few of them, and I'm experienced with these documents, they are very, very difficult. They are unintelligible. So it is completely lost in the small print what these people were signing up to. So to keep them out of any form of redress scheme, it's just completely wrong. And for the FCA to hide behind legal loopholes around what a contract for difference is, then it's just wrong.
Could I clear advice? It'll have to be very quick because I've got 4 more colleagues who want to come in, and we've got to get onto the floor of the House.
If I could just pick up on the point about the legal loophole, there is an issue about whether the hidden swaps are regulated products. It has to be investigated. I believe there's a very good argument that says they are regulated products. What I found extraordinary is we have Clive Anderson say to of the FCA say to the APPG the other day that they have not taken external advice upon whether these are regulated products or not. The regulator should take that advice and should publish it so that people can debate the advice sensibly.
You're giving very clear evidence, extremely helpful. Stuart Hosey.
Thank you very much indeed. I'll come back to that last point in just a moment. Before I do that, the FCA has said that from a customer perspective, the embedded IRHP products have similar features to standalone ones. What difference is there between the standalone interest rate hedging products compared to the embedded ones in practical terms for the customer? What's the difference? Sorry, Mr. Rowe.
In practical terms, there's not really a lot of difference. You get a double payment structure within a swap, so what is happening to you is very visible, and I think that's one of the issues with the hidden swap. There's a single payment, it's a flat payment, and people do not understand what is actually happening. I suppose the big difference is actually the swap and the associated loan are 2 distinct products. The hidden swap, you have a loan, and then within it you have a breakage mechanism. And it's the breakage mechanism which is actually the swap element. And most people don't experience that until they terminate or attempt to terminate their loan. That's the derivative part of the transaction. That is what makes the transaction a regulated product, in my view.
Which makes the embedded product, the TBL, more opaque. And as Mr. Murphy said,
in some ways, yes.
Right, okay. Was there a difference to anyone's experience in the way these products were sold, or were they sold on fundamentally the same basis?
The big difference is that with the swaps, there was a Treasury advisor in every case. Looking at the survey data we have, I would say that the pressure from the bank manager was saying, the representations made about interest rate movements was the same, the encouragement to enter into the transaction because the bank personnel were heavily rewarded was the same. What was different is that in the swaps they were always referred to a Treasury person, usually as an advisor. I can't deal with this, I've got to refer you to an advisor, to someone in the bank who can advise you. Where with the hidden swaps, the relationship manager plays a far greater part, and often there wasn't a Treasury person involved. Again, I think that raises issues about the legality of the actions of the relationship managers. If these products are regulated products, there's a problem.
Okay, and just to move that on a little further then, what's the difference in terms of the end result for the customer? We understand the practical difference, we understand there was unlikely to be a difference in the way it was sold other than the inclusion of a Treasury person, but what was the end result difference for the customer? If there was a breakage, for example, would there have been an additional penalty with the embedded swap as opposed to a standalone one, or would the end result have been the same?
No, at a breakage situation, it's the same result.
Right, okay. Now, to come back to the point you were making before about whether or not these are regulated, the FCA have written to the Treasury noting they did not have sufficient powers to look at these embedded IRHPs. You're suggesting that you think they do have the powers, that they are regulated, and certainly from a common sense point of view, if there is a mis-selling whether it's a standalone product or an embedded one, surely the mis-selling itself is worthy of investigation. So where do you think we are with this? And if the FCA don't have the power, if they're not regulated, I presume you would argue the Treasury should give them that power.
The Treasury should give a person that power. There needs to be an investigation. This is a problem, or potential problem. There are allegations that are very serious. For goodness sake, the government has to get in and investigate the issue. Frankly, who does it is sort of secondary to that. But logically, it should be the FCA. Our response to the FCA statement that it's not within their jurisdiction is very simple. There's a lot of literature from the FCA about how they've moved to principle-based regulation. And that deals with issues about the conduct of the banks. We're saying 2 years ago we came and said there was a problem about the conduct of the banks, and we have demonstrably been proven right. Over 80% of the people have had their product effectively torn up. We're saying again there's an issue about the conduct of the banks. If you've got a principle-based regulation system, the conduct of the banks, the propriety of that conduct, is something that you have authority to investigate. So do so. Then you move to a technical argument where the FCA are taking, even though they're expressed to be a principle-based regulator, they're taking a technical issue and saying, no, this prevents us dealing with this matter. I actually think there's a very good argument for saying that the technical argument they're making is defective. But it's not up to a small business and half a dozen lawyers I've spoken to. It's up to the regulator to ensure that that argument is effective, get an opinion from a top-flight silk, publish it, and that everybody can understand what they are saying. When I go through the Financial Services and Market Act, 2000, the Regulated Activities Order, when I go through the Markets and Financial Instrument Directive, I think there's a very good argument for saying these are regulated products. But I'm not the one to determine it. Someone appropriately qualified is.
Very, very briefly, because I know others have questions. Why do you think the FCA are taking this approach?
Why do I think the FCA needed to be pushed into reviewing?
Why do you think they've not jumped into this and investigated?
In our submission, bully banks refers to the DNA of the regulator. We think that's an issue. In our experience, the FSA, the FCA, approach an issue with a very friendly attitude towards the banks. Their DNA, their natural approach is that the banks are responsible, sober, contributing citizens.
Perhaps it's not what the regulators here tell us, and of course it's particularly not what the banks tell us about the conduct of the regulators.
Well, it's what we see.
It's a fascinating triangle in which
but a very simple issue, which is indisputable.
Light.
When the FCA announced their scheme, they put in place a concept that you would get 8% interest, simple interest, if your product was cancelled, you refunded money. You would separately receive consequential loss. We have Barclays Bank insisting that 8% covers consequential loss and effectively pressurising people to whom they missold a product to accept it. The regulator stands back and allows that to happen. That is wholly wrong. The regulator has not got the approach to regulation which the bank's conduct requires.
Well, we're not going to form judgments on all this right now, but I'm sure the committee is taking note of what you're saying, and we must give other witnesses an opportunity to chip in. And with that in mind, I'm sure he does have it in mind. I'll pass you to Brooks.
Yes, and look, I'm highly sympathetic to what the Friends of Bully Banks have certainly gone through, and notwithstanding the I guess the point highlighted by the chairman, the vast majority of people out there probably have not been abused, but that does not negate the point that there is a significant minority of people that have faced abuse, whether it's swaps or invoice discounting and so on, and something does need to be done about this. Now, turning to you, Mr. Rowe, a survey by bully banks suggested that the average fees charged due to entering a special situation division such as GRG was £327,000 per business. This doesn't sound like chopped liver to me. It's a big number. Does this match your experience from cases presented to your firm?
There's no question. We have complained about the conduct of the special management groups within each of the banks. RBS and GRG have been a particular focus of attention.
Yeah.
We have had 177 of our members reply to a survey which is still in draft, it's still in process, and we have found that there is an average charge to these businesses, and some of them are quite modest businesses, so the average is very important, of £345,000.
Right.
These are businesses who are in financial distress, according to the bank. They are moved into a specialist management function, the principal consequence of which is that the bank charges very significantly more fees, more costs.
Well, why do you think that these fees are so high? I mean, it seems to be a pattern here.
I believe that the special situation groups have become a profit centre of the banks. And as a result of that, they take the opportunities they have to make profit. And they do that by imposing charges on businesses. We have businesses who've got as many as 8 different levels of charge being imposed upon them.
You note that business reviews that SMEs are often forced to pay up for in special situation divisions are often not even made available to the business. Can you give an example of that?
Yes, again, it's something like 40% of the businesses have access to the reports for which they're charged. So this is RBS GRG specific. And I should say we're going out to the other banks as well and investigating their conduct. But with RBS GRG, we have the results in draft form. And the majority of businesses, in other words, do not see the reports that they pay for.
So we're just moving on because I've got a lot of questions here, unfortunately. To what extent do the high fees charged in the Special Situations Division contribute to the business ultimately collapsing?
A tremendous contribution. In our survey, the GRG's annual charges were over 10% of the turnover of the business in 32% of cases. They were over 40% of net profit in 38% of cases. In 20% of cases, GRG charges accounted for 100% or more than net profits.
Yeah.
So these charges are a very substantial burden on a business which has been moved into what is laughingly called a support function because they have financial issues.
Yeah, I just God, time I've got
No,
lost.
I'm only glancing.
Yeah, it's a philosophical.
For a bit.
It's a philosophical question. Why do you think it is that banks, which are in the business of helping businesses, because they're in the business of, keeping a business alive, should be a long-term proposition because they can earn fees over 10, 20 years. Why do you think we've come to this sort of situation in which it seems, at least the perception is there, according to evidence from you guys and others, that the culture's changed, where it's actually easier to make a quick buck by pushing a business into distress and ultimately forcing it to collapse?
But it's sort of improper incentivization. If you incentivize this group on the basis that they've got to get maximum fees out of the businesses for which they're responsible, that's what they'll do.
Right.
But that shouldn't be the proper incentivation of individuals in the bank. Of course, the bank should look at incentivising its staff so that they nurture, they nourish, they assist businesses to develop.
Okay.
Very interesting point, which the Banking Commission went into in some depth.
A submission to the Commission from the legal firm Berg noted that broad wording of covenants and contractual provisions have allowed RBS to, quote, find fault where none on a common sense analysis exists. Do you agree with this assessment?
In certain cases, the answer is yes. The statistics are wonderful. The data's out there. 47% of our survey individuals were not told that they were being transferred to GRG. 90% were not in default prior to the transfer to GRG. 33% were never told of the reasons for the move to GRG. Each one of those statements I find extraordinary.
Yeah.
We're going to have to move
okay,
on.
one last question.
One last quick question. We've got
Of the
a couple more colleagues to
cases,
get in.
cases that you have seen where businesses are unhappy about their treatment after being placed in a special situation division, how many are from GRG and how many are from the rest? And do you think this is a reflection of RBS's? I'm assuming it's the majority.
We have focused on GRG RBS because of the certain circumstances, certain events required us to focus upon them. I think they're likely to have been worse than the others, but the conducts complained of are complained of by customers of all of the banks. And I believe that you will find, when we do surveys of each of the other banks, data which is broadly similar.
So it just happens because RBS is particularly big that you're seeing sort of more from RBS, but it's a consistent theme throughout the industry.
But it's also the Lawrence Tomlinson report, the independent person who's been appointed by the FCA. That's prompted a focus on RBS, GRG, and we're reflecting the results of our efforts to respond to that focus.
Okay, thank you, Chairman.
Before passing the questioning on to George Moody, I'm going to ask Mr. Beer and Mr. Murphy if you have anything you want to add to what you've just been hearing. You're not obliged to, but anything you do say will be taken down in evidence.
I think just, and again, I talk around my own business, so, and you take of it as you will. In answer to the point about a reason behind why the banks behave in the way they do, I know from conversations I had with my bank, the conditions of banking were one of the things that changed. So when we took our loan of 3.9 million was pre-Basel III. What happened, as far as I understand it, is the bank has lent 3.9 million. There's then a European banking directive that says now you have to assess that loan in terms of its relation in this risk-weighted sector, and we now need you to put additional capital into your balance sheet. The problem for my business is then the bank sits there and goes, well, the ROI on 3.9 million was X, but now it's 6.9 million and this loan is underwater. And so the relationship with your bank is fundamentally changed, not through fault of my own, not necessarily through fault of the bank, but the simple truth is they now look at my loan as something that actually costs them, and it is of greater value.
It's the fault of the bank for having got their balance sheet so weak.
If I can say that sounds like a financial form of Stockholm syndrome, you shouldn't be making excuses for the bank's behaviour. Seriously.
But anyway, we've got the point. Mr. Murphy.
On the TBL point and the rights and wrongs of the FCA's approach to it, I think.
Could you possibly speak up, Mr. Murphy?
Yeah,
come closer to the microphone.
On that TBL point and the rights and wrongs of the FCA approach, I think the bottom line is that no regulatory authority is looking at TBLs currently on behalf of the consumer. And that is what needs addressing. It's been lost between organisations, and people keep talking about it, and this has been going on for 2 years, and nothing's happening with it. Right. The only recourse for those people with a TBL is to go via a lawyer and incur very expensive legal fees. Well, that can't be right.
We're taking a look at it right now.
On GRG and costs of underperforming assets, that's a topic all on its own. I don't recognise the numbers that
we shouldn't be having to play this long stop role, but it does seem to have become part of what the Treasury Committee does these days. George Moody.
You see, since we started this inquiry, I've been just totally puzzled by the phrase commercial banking, commercial lending is not covered by the regulator. I mean, Mr. Murphy, Bergs, who are a reputable specialist firm, in the evidence they've given us, quote at least 10 themes where the bank are deliberately screwing small businesses, finishing them off, interfering with their contact, manoeuvring them, engineering defaults, pretending to comfort them, but by comforting them they change and finish them off, overdrafts into loans with fees, etc., all designed to finish them off and they pull the money back. Now, why is that not a straightforward matter for the Financial Conduct Authority if they're living up to their names and the bank's conduct is within their remit? How do they come with this magic? Commercial lending is not dealt with by the regulator. They are the Financial Conduct Authority. All those things might be legally challengeable, if you wish, and that's what some of the companies are told to do, incredibly small businesses, but they're morally and economically quite disgraceful conduct by the banks, and they're happening bank after bank after bank. Now, tell me why they're not immediately, these complaints are not immediately taken by the Financial Conduct Authority and investigated, and if it needs legislation, if financial conduct, demand legislation from us. It is disgraceful. We're having good, hard-working people. We need to be hard-working people coming here and seeing their businesses either sterilised, controlled or wiped out because of behaviour, disgraceful behaviour by banks, and I've seen it firsthand.
No, I agree, and we regularly ask the FCA and challenge the FCA on their role in this, and they regularly just bat it back. Where a lot of companies have got caught out is when a bank has taken a negative sector view, whether it be hotels, property, whatever that may be, and then they've picked up the facility letter and they've used that facility letter to exit businesses from the bank because they're not in a sector that they like, and that is fundamentally wrong. And this is where the behaviours cross the line and they do start using subjective clauses in facility letters, which the FCA should remove. You've either breached a financial covenant in a facility letter or you've entered administration. All this weaselly words around material adverse change and dropping of values in businesses, that should be stripped out of facility letters. And I'm doing a deal at the minute because I'm on both sides of the fence, and we're borrowing off NatWest, and we're supposed to be completing this deal this week, and their argument is, when we're trying to get these clauses changed, and we've only recently had the facility documentation, is you've got to go back to credit to get that changed. In other words, we'll go back to credit, but you won't hit your Friday completion date. Yeah. So these weaselly words, and we're professionals at this, they stay in the facility letter. So they've got these material adverse change clauses, and they're not that material.
So just on that point, do you think it is common for banks to take advantage of the knowledge of the completion date in order to change terms or tighten terms as the sand is running out of the hourglass?
It was common in interest rate mis-selling, undoubtedly. That was a common feature because it came in late. And what was often happening is when they're bidding for the business, and this is the fundamental point, when a bank's bidding for business, and we've got 3 banks lined up, we're comparing terms and trying to get the best deal, you'll get term sheets out of banks, and they're quite woolly around key points. Company then narrows down to one bank, and he runs into completion, whether he's buying his property, buying his business, whatever he's doing, rebanking. The final facility letter comes out, and the terms in that are different, in the sense the nuances in the legal wording is much more favourable to the bank, and that's where you get caught out. Okay. And then you've not got time to get that changed. And the bank turns around and says, well, tough, take it or leave it.
You see, we've gone through this with the consumers, the bank customers. In the last Parliament, they came and we had the same sort of tales. The banks were brought in here and the banks were told and the regulators were told and things changed. Now, why are you not demanding the same sort of status as the individual customers have got. I'll give you an example. I get a mortgage on a £100,000 house. The market goes down, I'm in negative equity. I never heard of a bank pulling me in and saying the loan to value has changed, so therefore, but it happens with you. Why?
Yeah.
And why do you put up with it?
Well, if you think of it, it's not logical. If a bank offers a 10, 20-year property loan, they're taking a 10, 20-year view on property prices. And they know that it goes up and down.
Yeah.
So to pick a point in the cycle to pull the loan when it's dropped, it's just completely counter to the actual purpose.
And if you
of the
know
loan.
that, Mr. Murphy, why on earth are you screaming at us as legislators to do something about it?
I think it's something you give up.
Well,
No, the regulator is the FCA as far as I'm concerned. The regulator doesn't respond to these things. It's not my problem. So where do you go? Now, if there was a FOS SME entity that was responsible for SMEs, then perhaps that's a proper voice, and that's where we need to go.
Yeah, okay.
Pat.
Well, I just want to ask you about that. What we've had for the last sort of however long you've been sitting here, 3/4 of an hour or so, is a tale of where you think redress stops or can't be accessed by banks who've been sold these products or missold these products. So I just want to ask you to make some recommendations to us as to how to fill in those gaps. We heard from Mr. Rowland earlier about what the regulator will do and not do. The other piece of this that you just mentioned, Mr. Murphy, is the Financial Ombudsman's Service. Can you just recommend to us what change you would like to see in the Financial Ombudsman's Service remit that would allow them to play the role you want?
I think there's two legs to that. I think internally banks need complaints procedures that have teeth and are viewed as independent. That's difficult because they're being paid by the bank.
How do you view this Russell Briggs process?
I've not looked at it in depth, but I think at the minute we've no faith in the internal procedures now. We just don't get anything out of internal bank procedures. It just disappears. And then you're into FOS, but FOS is for micro businesses. So my point is that the vast majority of SMEs and businesses have no recourse to an independent external.
So what would be the change in the FOS remit you would want to see?
Well, I think the different businesses, where FOS is now up to €2 million turnover, fine, keep that, but then you have FOS Mark 2 that goes up to say 25 million turnover sterling for SMEs, so it tracks SMEs. So then and then that will then keep banks internal, hopefully keep bank internal procedures on the toes, because at the minute they know you've nowhere to go.
So because they don't fear an appeal to FOS, you think they can just dismiss appeals to that?
Well, you can't go to FOS. If you're outside, €2 million turnover, you've nowhere to go.
Okay, what about the regulator? What would be the change you would want to see in the regulator's remit if the regulator is saying on one type of interest rate hedging product we've got a locus to act, but on another, which from the customer's point of view can look quite similar, we don't. What's the change there then?
The regulator, to me, he is hiding behind loopholes in what's regulated and unregulated. He's just got to just get off the fence and act commercially. And if it walks like a duck and quacks like a duck, it's a duck. And damn well get on with it and get it in the scheme, instead of just hiding behind words, frankly.
As Mr. Moody said, with or without any legislation that might come from this place. Mr. Rowe, same two questions really. What would you like to see from the FOS remit and the regulator's remit?
I think you have to put in place, if you've got like a holistic system, if I use that terrible word, you start with a bank's complaint process that is open to assessment, and that means publication by each bank of the data about what is happening within its complaint processes. You put in place that to encourage the banks to have an effective complaint process. The next step is you then put in place a FOS which has got appropriate jurisdiction levels, and this need to be substantially increased, and the FOS have to also give detailed information not only about their conduct but about the conduct of the banks, because one of the problems with anything going through the Ombudsman at the moment is the delay that's created by the banks regularly being very dilatory in meeting obligations to disclose documents and make submissions. So you have an effective disclosure. It really is all about measurement of performance.
What kind of size of business do you think, Mr. Murphy mentioned the figure of £25 million annual turnover compared to the €2 million at the moment. Would you think that's in the right ballpark, or is there a number of employees? How should the FOS draw this line?
I think you'd look at the European legislation and you talk about sort of 250 million, you talk about 250 employees. You put in place a jurisdiction that enables small businesses, small and medium-sized businesses, to challenge these Goliaths. The banks have immense power. Like all power, it corrupts, and it has created a set of relationships which is not equitable, which is not fair, which is not actually helpful to this country. They damage the economy of this country through those relationships. So put in place a series of processes which give power, if you like, back to the people, power back to the small businesses, so they can conduct themselves with their banks on a more even scale.
And from the regulator?
From the regulator, a change in culture from the regulator, so that they become much more assertive. Now they stand back and say our powers aren't sufficient. Right, give them the powers.
It's the powers thing that I'm really focused on. I'm looking for a specific from you beyond change in culture. What is it that you would like to see in the regulatory remit that you think?
Well, if they say commercial banking is outside their jurisdiction, for goodness sake, put in place a set of provisions which is absolutely clear that if they see misconduct by the banks in any area, it's within their jurisdiction. They are the financial conduct authority. That's what they're supposed to do.
Okay, thank you. Mr. Beer, same questions really. Should we start with the FOS? What do you think their remit should be in this?
I think all of this comes back to the question you asked me about, is there trust between business and banking? And at the moment there isn't. So what do I want to see from FOS? Imagine how I feel when I sit just above the threshold of €2 million, and I've got nowhere to go.
Yeah.
So I don't trust my bank, and I don't trust that at the moment government legislators, etc., are actually listening to what the needs of SME. And it gets highly frustrating when you hear constant rhetoric saying how important SMEs are to the recovery of this economy, and then you say, well, where's
I'm giving you an opportunity to make a concrete recommendation to legislators on FOS remit.
Then address, as Tim and as Jeremy have said, create FOS that actually takes in SMEs.
Do you have a view of what? I'm not expecting you to write the legislation here, but what kind of ballpark of turnover or employee numbers or how?
I'm not the person to ask that question. I'm here as representing my own small business. I was to talk about what happened to me.
Sure.
Okay. There's others that have far greater knowledge.
Okay.
But I think it's appropriate to hear that you've got a small business saying, "Why am I excluded?" It is wholly unfair that our business is dragged through this situation. And we have no source of redress, and banks are allowed to get away with it. And they are getting away with it.
Thank you.
It's extremely valuable evidence that we've heard again this morning from our second panel, and we're very grateful to all three of you. What we're hearing is a set of problems which the Treasury Select Committee hoped would at least be partly addressed, and I think can be partly addressed. We still think partly addressed through competition. We put forward a set of proposals to deal with it that way, but we were then hit by or shocked by a series of appalling conduct scandals which have led to the Standards Commission that was created, the Parliamentary Commission on Banking Standards. What you've described in microcosm is only more of what we heard in the extensive evidence that commission took. This is unfinished business. There's a heap of work to be done to put banking back together again in a form that can help the small business sector. And you've given us some interesting evidence to further the cause to take some action. Thank you very much indeed for coming today.
Portcullis House, the Wilson Room.